Hello, everyone, and welcome back to Gold Off the Charts, where we dive deep into finance every day, helping you see further and find your groove on your journey to build wealth. For today's episode, I suggest you put down whatever you're doing and turn up the volume. Why? Because we are at a pivotal moment mid-January 2026. This is very likely to be one of the most critical turning points for the financial markets in the next decade. When we look back years from now, you'll realize that what's happening these past few days was actually the early warning sign of a massive wealth reshuffle. You've seen the markets lately, right? It's been nothing short of a roller coaster. Especially silver, that trend has been straight out of a horror movie. 1 second it's hitting record highs, and the next it's dropping 7% in a guillotine fall, only to pull a massive V-shaped recovery. Then it drops another 2%. Many of my friends trading futures told me their hearts nearly stopped. They got crushed on both sides of the trade. And what about gold? Even though it's been volatile, it's holding steady just under the $4,600 mark, looking like it's ready to pop. What's going on under the hood? Is the bull market dead, or is this just one last shakeout? Today, I want to help you cut through the noise of these messy charts and see the truth behind this pullback. We aren't just talking about prices going up and down, we're talking about market divergence. Based on my analysis of the latest Goldman Sachs reports, the Bank of Japan's moves, and the Middle East crisis, the gold and silver brothers are about to go their separate ways. Gold is likely to take the lead and accelerate its run, while silver might be heading for a deep and frankly brutal washout amidst all this chaos. Why am I so confident? There are 3 mega signals behind this, each as powerful as a nuclear bomb. Today, we won't waste time on fluff or overcomplicated technical indicators. Let's look at the big players in this capital game and map out how this plays out for you. All right, let's get straight to the point. First, we need to understand the master switch behind all this mess. This switch is the core indicator in my title today, a number that is shocking even the veterans on Wall Street. It's the gold-silver ratio falling below 50. First, let's explain what this ratio actually means. For those of you who are new, you might think it's just a simple math problem. The price of gold divided by the price of silver. But trust me, this is no simple calculation. It is a thermometer and early warning system for the global economy. The fact that it's under 50 is a huge deal. The last time we saw this was back in March 2012. We are looking at an extreme phenomenon that hasn't happened in 14 years. Let's look at the history books. Over the last century, the long-term average for this ratio is around 60. That's the balance point. When it spikes to 80 or even 120, like during the 2020 pandemic panic, it means everyone is buying gold just to survive and nobody wants silver for industry. That's a sign of extreme fear and a stalling economy. But when the ratio dives below 50, or even tests 40 or 30, history shows us 2 possible endings, and they are both very dramatic. Scenario 1. Gold is dirt cheap. The market suddenly realizes that gold, the ultimate money, hasn't been priced high enough. So gold goes on a revenge rally, surging to pull the ratio back to normal. Scenario 2. Silver is in a massive bubble. Speculators have pushed silver to insane highs that don't match reality, leading to a bubble burst where silver prices crash to fix the ratio. So, here in January 2026, which scenario are we in? My take might be a bit tough to hear. We are facing a historic split where gold speeds up while silver corrects. In other words, these twin brothers of the metals market are likely about to part ways. I'm not just making this up. It's based on a deep dive into 3 core signals: Wall Street's secret plans, the currency war in Asia, and the drumbeats of war in the Middle East. Let's look at the first signal from the heart of global finance, Goldman Sachs. For the longest time, Goldman was the biggest cheerleader for a strong dollar. They sold everyone on the idea of American exceptionalism. Essentially, they argued that while Europe is struggling and emerging markets are a mess, the US is invincible because of AI and tech stocks. Because of that, global money had no choice but to buy US assets. This logic kept the dollar strong for years. But in their 2026 outlook, I noticed a rare, almost panicked shift in tone. Goldman is starting to throw in the towel. They openly admitted the dollar's reign is starting to fade. Notice their wording. They are acknowledging a slow ebb. They warned that while the dollar won't die tomorrow, the American exceptionalism belief is cracking. What is the biggest danger? It's a structural shift. Goldman mentioned a terrifying possibility. What if the faith in U.S. tech stocks collapses? The U.S. market is now heavily concentrated in just a few AI giants. It's a crowded trade. If there's a technological failure, or if these giants can't justify their insane valuations and big money starts pulling out, the dollar will crash way harder than anyone expects. Also, have you noticed something very strange lately? Goldman pointed out a decoupling between U.S. stocks and the dollar. Usually, when stocks go up, the dollar goes up, because foreigners need dollars to buy those stocks. But now, stocks are hitting new highs, while the dollar index is falling. This means smart money is hedging their buying Nvidia or Microsoft while simultaneously shorting the dollar. That is a very dangerous signal. It means capital is betting on American companies, but no longer on American national credit. Investors are saying, I want your AI tech, but I don't want to hold your paper currency. This shift from top banks is often the starting gun for a trend reversal. If de-dollarization was just a slogan for the last decade, it's now a real trading strategy on Wall Street in 2026. And when the dollar's throne shakes, where does the trust go? There's only one answer: gold. This is why gold is about to hit the accelerator. Moving on, let's look at Asia, specifically our neighbor Japan. This is our second core signal. The recent moves in the yen have left many Forex traders scratching their heads. It tanks 1 minute, then skyrockets the next. Behind the scenes, there is a high-stakes poker game between market speculators and Japanese officials. Nomura, Japan's biggest brokerage, just issued a red alert. The signals for Japan to step in and save their currency are flashing bright red. Their finger is already on the trigger. I want to teach you a professional term here. It's called a rate check. It's not really about checking rates. It's a scare tactic used by the central bank. How does it work? When the exchange rate gets too wild, Bank of Japan officials will suddenly call the big banks and ask, where is the dollar-yen trading right now? Do you have many big sell orders? The call itself isn't a trade, but the subtext is clear. I'm watching you. Don't push it, or I'm coming into the market. Nomura pointed out that during London trading on Wednesday, the dollar-yen suddenly took a massive dive for no apparent reason. Nomura's analysts believe this was likely a stealth rate check or a small-scale test of the waters. What does this tell us? It means the Bank of Japan is backed into a corner. A weak yen is causing massive inflation in Japan. When people go to the grocery store, prices are rising every single day, and businesses are being crushed by the cost of imports. This could force the Bank of Japan to raise interest rates much faster. The market expected them to wait until summer, but to save the yen, they might have to pull the trigger early. This is a massive deal. Japan is one of the world's biggest lenders. If they turn hawkish and start tightening the money supply, or even sell U.S. bonds to buy their own yen, it's like sucking all the extra cash out of the global system. What happens then? Global asset prices start swinging wildly, what we call a carry trade unwind, and gold thrives in that kind of chaos. Historically, every time the yen makes a major reversal, people flock to gold as a safe haven. So, a butterfly flapping its wings in Tokyo is about to set off a gold storm in New York and London. The third signal? We have to look at the Middle East. Powder keg. If you watch the news, you might think things with Iran have cooled down a bit recently. But I'm telling you, this is the calm before the storm. It's a period where a much deeper crisis is brewing. Why? Don't listen to what the politicians say. Look at what the military is doing. Troops don't lie. Recent intelligence shows that as tensions with Iran rise, the U.S. is moving a massive amount of forces back into the Middle East. Most notably, the Gerald Ford, the most powerful nuclear aircraft carrier. It was supposed to be elsewhere, but reports say the White House is moving it to the Middle East, along with more missile defenses. This gives President Trump a very real military option. The message is loud and clear. The U.S. doesn't think Iran or Israel is going to back down. This current peace is just everyone regrouping their chips before the next move. Plus, there is a concept here called the war economy. Some experts notice the Trump administration is basically running a shadow QE, printing money. What does that mean? Think about it. The defense budget, aid to allies, and moving supply chains all cost an absolute fortune. Where does that money come from? It comes from issuing more debt and growing the balance sheet. This is the long-term fuel for gold. War isn't just about fighting. It's about burning through cash. When the world goes into war mode, or security first, the value of paper money is destined to shrink, and gold is the best shield against that. If the Iran situation heats up, or even if the carrier entering the Persian Gulf is confirmed, gold's safe haven status will explode, blasting through $4,600 into a new rally. Now that we've covered gold's big picture, let's talk about the metal that everyone has a love-hate relationship with right now, silver. Silver's trend lately has been a total meat grinder. It dropped 7% yesterday, blowing up leveraged accounts, and the rebound today is struggling. There are three forces playing a high-stakes game here: physical supply, Trump's policies, and a sneaky change in exchange rules. Let's look at the first force, the physical gap. This is why silver bulls are so confident. I've said it before, the logic for silver is solid. We've had a silver shortage for 5 years straight. This isn't just hype, it's a real lack of physical metal. Data shows the risk of a supply squeeze on the futures markets is at an all-time high. Look at this crazy stat. For every ounce of silver in a vault, there are massive paper claims. About 590 million ounces of paper silver have been bought. But how much actual silver is in the warehouse for delivery? Less than 50 million ounces. Do the math. 50 million versus 590 million. That's a coverage rate of only 7%. That means if 100 people wanted to take delivery of their silver, the warehouse only has enough for 7 of them. The other 93 would get a default or a cash payout. That's why silver spiked. Everyone was fighting for the last few chairs in the room. It's a literal game of musical chairs. Add in China's export controls on silver that started January 1st, and the shortage is getting even worse. That's the bull case for silver. But the second force, Trump's latest move, just hit the market like a ton of bricks. Just as silver was peaking, Trump tweeted that he would pause new tariffs on imported critical minerals. The market expected tariffs to break the supply chain and send silver prices even higher, but Trump said, "Let's talk first, no hikes yet." Suddenly, the immediate supply shock fear evaporated. A lot of traders who were sitting on big profits decided to sell immediately. That led to yesterday's 7% crash. That's how fast sentiment changes based on the news. However, the third force is what really moved the needle, the CME fatwa. This is a technical detail most retail traders missed, but it's likely why you lost money. You lost to the rules. On January 13th, the CME group quietly changed their risk management rules in a way that is deadly for leveraged traders. They changed how they calculate margin, the deposit you need to trade, from a fixed dollar amount to a percentage of the value. Under the old rules, whether silver was at $30 or $50, your deposit per contract stayed the same. That meant as the price went up, the total value of your position grew, but your required deposit stayed the same. Your leverage was effectively growing on its own. Speculators loved this. The more it rose, the more they could buy. But the CME said, no more. Now, they charge a percentage, like 9% of the contract's total value. If silver goes to the moon, the contract value might hit $500,000. Suddenly, you have to cough up a $45,000 deposit. What does this mean? It means the higher the price goes, the more cash you have to lock up. This is a nightmare for over-leveraged traders. You thought you could use your profits to buy more, but the exchange says your profits aren't even enough to cover the new deposit. This forced a massive amount of long positions to close. They couldn't afford the margin, so they had to sell. That selling pressure is what's stopping the rally. So, the CME basically stepped in to cool the room and pop the speculative bubble. When you put these three forces together, the picture is clear. Long-term shortage versus Trump's tariff pause, bearish versus CME rule changes, leverage killer. The result, the silver rally has hit a wall. That's why my theme is, the ratio broke 50 and the split begins. Here is how the future looks. Gold is supported by the falling dollar, the yen crisis, and Middle East tension. It doesn't have nearly as much speculative baggage as silver, and central banks are buying it up. So, gold will lead the charge. Its move will be steadier and stronger, and it should keep breaking higher. Silver? I'm still a long-term bull, but in the short term, because of the leverage, wipeout, and industrial demand fears, silver is going to be a wild, choppy mess. We might even see a deep pullback. It needs to shake out the weak hands and let the gold-silver ratio reset back towards 60 before the next leg up. So here is my honest advice for you. First, for silver, it's time to dial back the greed for a moment. The outlook is good, but right now we're watching the gods fight. The CME's new rule is a sword of Damocles over your head. Don't use high leverage here. This volatility can wipe your account to zero in a single day. If you have physical silver, just hold it. Physical owners will win in the end. But if you're trading futures or paper silver, now is the time to trim your positions and manage your risk before the panic gets worse. Second, for gold, you can have a little more faith. In the uncertain world of 2026, with a weak dollar and war looming, gold is the strongest shield you can have. If the gold-silver ratio keeps correcting, gold's upside might even surprise you. One final thought. In a financial storm, surviving is more important than getting rich quick. My goal is to help you see the risks, not to gamble. This isn't formal advice, but just some heartfelt words from someone who has been in these markets for a long time. Trading is your responsibility, so make your own choices and watch your wallet. That's all for today. If this logic helped you make sense of this crazy market, please leave a comment with your thoughts. Don't forget to like, subscribe to Gold Off the Charts, and share this with your friends. Stay safe out there in the storm. See you next time.